In September 2008, one of America's biggest investment banks suddenly disappeared. Not slowly, not after months of negotiations. It simply filed for bankruptcy. And what happened next was terrifying. Banks stopped trusting each other. Credit markets started freezing. One of the world's biggest insurance companies needed an emergency rescue. The stock market was collapsing, and governments around the world were scrambling to stop a financial panic from turning into something much worse. But here's what makes the 2008 crash so frightening. Lehman Brothers wasn't the beginning of the crisis. It was the moment the world finally realized just how broken the system had become. And by the time everyone understood what was happening, it was already too late. So, how did a housing boom turn into a crisis that nearly brought the global financial system to its knees? To understand that, we need to go back. 1. When everything looked fine. The story starts in the early 2000s. America had just come through the bursting of the dot-com bubble, and the economy was slowing down. So, the Federal Reserve responded by cutting interest rates aggressively. Borrowing became cheaper. And when borrowing gets cheap, people tend to borrow more, a lot more. One of the biggest places that money started flowing into was housing. Americans bought homes. Banks handed out mortgages. Home prices kept climbing. And as those prices climbed, people became more and more confident. Because if your house was worth more this year than it was last year, borrowing against it didn't seem particularly dangerous. It actually seemed pretty smart. By the middle of the decade, home ownership in America had reached historic highs. The housing market no longer looked like a risky investment. It looked like a machine that could only move in one direction, up, and that belief would turn out to be one of the most expensive beliefs in modern history. 2. The mortgage machine. Here's where things get a little complicated, and honestly, this is where most explanations of 2008 tend to lose people. So, let's keep it simple. Imagine a bank gives someone a $300,000 mortgage. Normally, the bank would sit there and collect payments from that homeowner for decades. But banks figured out they didn't have to wait that long. They could bundle thousands of mortgages together and sell them to investors. These became mortgage-backed securities. Then Wall Street took the idea even further. Different mortgages could be bundled together into increasingly complicated financial products called collateralized debt obligations, or CDOs. And suddenly, a mortgage wasn't just a mortgage anymore. It had become something that could be bought, sold, packaged, rated, and traded all over the world. And this created a pretty powerful incentive. The more mortgages banks could create, the more products Wall Street could sell. And the more products Wall Street could sell, the more money everyone could make. There was just one problem. Some of those mortgages were terrible. People with weak credit were getting loans. Some loans required very little documentation. Some borrowers had very little ability to actually repay what they had borrowed. But as long as home prices kept going up, the system seemed to work. If someone couldn't afford their mortgage, they could potentially refinance. If they couldn't refinance, they could sell the house. And if the house was worth more than they originally paid for it, well, everyone walked away happy. At least, that was the theory. 3. The system had a secret. The real danger wasn't that bad mortgages existed. Bad loans had existed before. The problem was that these bad loans weren't staying where they started. They were being passed around the financial system. Banks didn't necessarily keep the mortgages they created. They sold them. Investment firms bought them. Financial institutions repackaged them. Rating agencies evaluated them. And investors all over the world bought them. Eventually, nobody could easily see where the original risk had actually gone. It was everywhere. And because many of these products received high credit ratings, they were treated as relatively safe investments. The system had taken thousands of individual mortgages and turned them into one enormous financial web. And everyone had a reason to believe that web was safe. Banks were making money. Investors were making money. Homeowners were watching their property values rise. Wall Street was collecting fees, and rating agencies kept giving strong ratings to financial products that ultimately depended on borrowers continuing to make their mortgage payments. The machine worked as long as housing prices kept rising. That was the assumption underneath almost everything. And then, housing prices stopped rising. 4. The first crack. By 2006, the housing boom was starting to lose momentum. Home prices peaked, then they started falling. At first, it didn't look like the end of the world, but something had changed. Borrowers started defaulting. Subprime mortgages began failing at much higher rates, and suddenly, all those financial products built from those mortgages weren't worth what investors thought they were worth. The problem started spreading. Mortgage lenders went bankrupt, hedge funds exposed to mortgage securities collapsed, and in 2007, two Bear Stearns hedge funds failed. That should have been a warning, but the financial system was still standing. So, a lot of people assumed the damage was contained. It wasn't, because the housing market wasn't just a housing market anymore. It was connected to banks. Banks were connected to investment firms. Investment firms were connected to insurers. Insurers were connected to investors. And investors were connected to practically everything. The house of cards had already been built. Now, someone had started pulling the cards out. 5. Bear Stearns. By March 2008, things had become much more serious. Bear Stearns, one of Wall Street's major investment banks, was running out of funding. The firm was facing a liquidity crisis, and the Federal Reserve helped facilitate a rescue in which J.P. Morgan Chase acquired Bear Stearns. The details were extraordinary. A company that had once been one of the biggest names on Wall Street was suddenly fighting for survival. But the rescue bought the system some time, and for a few months, it looked like maybe the worst was over. It wasn't. In September, the government seized control of Fannie Mae and Freddie Mac after the two mortgage giants came under severe financial pressure. Together, they were deeply embedded in America's housing finance system, and then came the moment that changed everything. 6. Lehman Brothers. September 15, 2008. Lehman Brothers filed for bankruptcy. At the time, it was the largest bankruptcy filing in U.S. history. And unlike Bear Stearns, Lehman wasn't rescued through an institution-specific government support program. The decision shocked financial markets. But the real problem wasn't simply that Lehman had failed. It was that nobody knew what would happen next. Who owed Lehman money? Who had invested in Lehman's securities? Which banks were exposed? Which insurance companies were exposed? And just how much of the financial system was connected to the company that had suddenly disappeared? That uncertainty was toxic, because financial markets depend on trust. A bank doesn't need to believe another bank is perfectly healthy. It just needs to believe it's going to get its money back. Suddenly, that confidence was disappearing. 7. Then AIG needed $85 billion. The very next day, things got even more frightening. AIG, one of the world's largest insurance and financial services companies, received emergency support from the Federal Reserve. The initial Federal Reserve loan was $85 billion. Think about that for a second. The day before, Lehman Brothers had failed. The very next day, AIG needed an enormous rescue, and the financial system was still moving. But now, people understood something terrifying. This wasn't about a few bad mortgages anymore. The problem was systemic. The financial system had become so interconnected that the failure of one major institution could threaten others. And after Lehman's collapse, a money market mutual fund holding Lehman commercial paper was unable to maintain the normal $1 share value. Investors started pulling money from money market funds. The Federal Reserve responded with emergency lending programs designed to keep credit markets functioning. The panic was no longer confined to Wall Street, it was spreading. 8. The part people underestimate. This is the part of 2008 that's easy to miss. The crisis wasn't simply banks made bad mortgage loans. The deeper problem was leverage, interconnection, and trust. Financial institutions had built enormous positions around assets that were ultimately connected to the same housing market. So, when housing prices fell, the losses didn't stay inside housing. They moved through the financial system, and once people stopped trusting the value of those assets, they stopped trusting the institutions holding them. And that's where things can get ugly very quickly. Banks become afraid to lend, businesses struggle to get financing, investors start selling assets, asset prices fall, losses increase, confidence falls even further, and the cycle repeats. That's what made the crisis so dangerous. The financial system wasn't just losing money, it was losing trust. 9. Wall Street became Main Street, and eventually, the crisis left Wall Street. The U.S. recession had officially begun in December 2007. By the time the economy reached its trough in 2009, U.S. GDP had fallen 4.3% from its peak. Unemployment, which had been below 5% before the recession, eventually reached 10%. Home prices fell roughly 30% from their mid-2006 peak to their mid-2009 trough, and the S&P 500 lost 57% from its October 2007 peak to its March 2009 low. But statistics don't really tell you what a crisis feels like. Millions of people lost their homes, millions lost their jobs, retirement accounts were devastated, businesses failed, and families that had spent years building some kind of financial security suddenly found themselves underwater. The crisis had started with mortgages, but it had become a crisis of ordinary life, and it didn't stop at America's borders. Banks around the world had purchased U.S. mortgage-related securities. Financial markets across Europe and elsewhere were hit. The crisis had become global. 10. The government's $700 billion gamble. Now, governments had a choice. They could allow the financial system to keep collapsing, or they could intervene. In October 2008, Congress authorized up to $700 billion for the Troubled Asset Relief Program, better known as TARP. The goal was to stabilize the financial system and prevent an even deeper economic collapse. The Federal Reserve also pushed interest rates down dramatically. By the end of 2008, its target range for the federal funds rate had reached essentially zero, and the Fed created extraordinary lending programs to keep credit flowing. The interventions helped stabilize the system, but they created another problem. Millions of ordinary people had just watched their homes and jobs disappear, and now, some of the institutions associated with the crisis were being rescued. To many people, it looked like Wall Street had taken the gamble, and Main Street had received the bill. 11. Did we fix the problem? Eventually, the economy recovered, but the scars lasted much longer. The recession officially ended in June 2009, yet unemployment remained elevated for years. Home values took years to recover, and the financial system underwent major reforms. In 2010, the Dodd-Frank Act introduced sweeping changes to financial regulation, including stronger oversight of large financial institutions and new mechanisms intended to reduce systemic risk. The Federal Reserve also expanded its role in supporting financial markets. The idea was simple: make sure the next crisis couldn't become another 2008. But there's an uncomfortable question: did we actually eliminate the risk, or did we simply build a system designed to survive the next version of it? Because that's the strange thing about financial crises. They rarely begin with someone standing up and saying, "Today, we're going to destroy the economy." They usually start with decisions that seem reasonable. Borrow a little more, take a little more risk, assume prices will keep rising, trust the rating, trust the model, trust the bank, trust the market, until eventually, everyone is depending on the same assumption. 12. The real lesson of 2008. The 2008 crash wasn't caused by one greedy banker, it wasn't caused by one bad mortgage, and it wasn't caused by one company. It was a system that rewarded more lending, more borrowing, more leverage, more complicated financial products, and more confidence that the good times would continue. Then, housing prices fell, and the system discovered something it had forgotten. Risk doesn't disappear just because you move it somewhere else. It just becomes harder to see. Lehman Brothers wasn't the whole crisis. It was the moment the hidden connections finally became visible. And that's why 2008 was worse than most people remember. The biggest danger wasn't that one bank could fail. It was that nobody knew how many other things could fail with it. A housing problem became a banking problem. A banking problem became a credit problem. A credit problem became an economic crisis. And an American financial crisis became a global one. The crash wasn't just about houses, it was about trust. And once the world stopped trusting the system almost stopped working. This is Casual History, where the biggest stories about money, wealth, power, and collapse aren't just history, they're warnings about how the world works.